Okay, it's 6:01. I'll call the Finance Committee to order.
You know why? Because I'm on that. Sorry, Chuck. You're going to get our personnel and interviews.
All right, let's start off with a presentation. Sean had contacted me a few weeks ago and asked that since the audited financials were done, to put Tosky and Company on the agenda for a presentation. So here they are. The floor is yours. You can, Tom, you can introduce yourself.
Sit right here and talk like this?
Wherever you want. If you feel comfortable walking and talking, that's up to you.
Okay, I'll be here. And you'll be here. Okay. All right. I'm Joe Klimek. This is Tim Thomas. We're both directors at Tosky and Company, and we've met us before. We've been in a Finance Committee meeting before to discuss certain options that you might have. What we have here is two documents. Okay, what's handed out. One is the official financial statements, which is the annual update document that goes to state controller. And in there is our reports and lots of information by fund. And what we have done is, for tonight's meeting, is handed out a shorter document that will kind of condenses all this information into one document. We want to take you through that first, okay? And then the questions on the larger one, we can go through later, but I think you should have all the questions answered by going through the smaller presentation. It's called the Finance Meeting Presentation, October 15, 2013. Okay, there's 21 pages, and first page look at is the report to the board. To the Board of Supervisors, which in a year from now will be a completely different legislative body. But this is to the report to the Board of Legislature, and basically we have audited the statutory basis financial statements of the county for the year ended December 31st, 2012. So these statements are not in accordance with general accepted accounting principles. As we explained before in the previous meeting, these statements are in accordance with the State of New York statutory basis annual update document. And that's what we audit. We audit basically by fund within that financial statement. We did have a qualified opinion on your 2012 statutory basis financial statements. And this is all related to the Internal Service Fund, which accounts for the county's self-insurance expenses. Because of the accounting for that Internal Service Fund is not yet completed, we have qualified certain funds and amounts in the financial statements. The costs of the retirement incentive have been moved over to the Internal Service Fund. Those costs are on a premium equivalent basis, not on an actual cost basis, because of that, they're not in accordance with general accepted accounting principles. Once the accounting of the internal service is done, which I understand it will be completed very shortly, the 2013 financial statements of the county will no longer will have enough information to audit unqualified financial statements for the year 2013, and that's the game plan. However, we issued a qualified opinion. Where in the prior year, for year ended 2011, we issued a different opinion. We issued a disclaimed opinion on your financial statements. So we gave you no opinion at all on your 2011 financial statements and the related findings that we have with the single audit. So that's the significant audit findings, page 1.
That's a huge step too, by the way, towards getting to an unqualified opinion. We were actually able to, based upon the accounting and the work that has been done since last year, isolate the problem to the general fund and to the internal service fund. And instead of disclaiming an opinion, because the potential for the misstatement to run throughout the entire financial statements, we were able to isolate it to the general fund and the health insurance related expenses therein and the internal service fund. So we made, while it sounds like semantics, we made a huge stride because of what you have done in that period in terms of getting the accounting done and identifying where the costs are and what they are. And that's really significant.
Thank you. And on the next page, we talk about
Yeah, you might want to just clarify that, don't talk as accountants, talk as supervisors. You know, I know you've got it in this, unlike in 2000, we're able to isolate the effects of the scope limitations to the general and internal service funds, and that's what you've been talking about. You know, the improvements that have been made, you know, with the treasurer's office and with the trust itself. So it's, I can see in some of their eyes, yeah, it's kind of a question of what you were talking about.
Okay, like the year before, because the accounting of the treasurer's office did not include adjustments that were made this year to certain accounts, like deferred revenue accounts and certain things. It was kind of prevalent throughout all the funds of the county. The fact that the accounting for this insurance, so for your self-insurance fund, which contains the county and other municipalities, was not isolated enough. We could not issue any kind of opinion at all. So we issued no opinion. We said we disclaimed the entire opinion. Now we're qualifying the opinion to certain areas of your financial statements, not the entire financial statement. So we have a qualification based on the fact that the internal service fund accounting is not yet complete, and the effects of that really on the general fund. So those two funds, we have some issues with, isolated to retirement, to health insurance expenditures, and some related reimbursement issues that are related to the claims that DSS puts into the federal government, into the state government.
Yeah, and tomorrow night we hope during their presentation of their budget request for this year, we're going to try to make that transition from 12 and 13 into 14's budget to try to make it a little more clarified for everyone.
Sure.
So that'll occur tomorrow also.
But just to take it one step further, when we say we have qualifications, you can say, well, gee, did we spend the money wrong? We're not talking about propriety of the expenditures. What we're talking about is the recording of the expenditures, and I think that's a significant difference. We're not saying that there's anything wrong with the way the money was spent. We're saying that we're not sure that the way it's reported is the way it is what reflects what truly happened. And until we get that accounting done, we can't get to the point where we can say, yep, in our opinion, that's the way it is. So that's where the qualification comes in.
Okay, Tom, do you have a question or just?
Well, I'm, you know, if I'm the person who's sitting over here in the desk, not quite understanding everything in your terms, I think what you're saying is, correct me if I'm wrong, over the past few years, when you say you disclaim, what you mean is you can't come to a conclusion and give us an opinion because of the way that it's laid out, or it was laid out for you. Now, with the work that's been done, you can give that, get a lot closer to giving that opinion. Is that?
That's very good layman terms, yes. To understand this, a unqualified opinion says that everything's in accordance with the statutory basis of accounting, which is really on a modified accrual basis of accounting for all your funds. We can't say that now because the accounting, what we have done was isolated where the error could be.
Right.
Now, where before we couldn't isolate where the error was.
It's what you call us bean counters. None of the beans are missing. We're just not sure they're in the right buckets.
Right.
Is about what it boils down to. So that's the basis for our qualification of opinion. But we're
Once
closer
you
to
get all the
saying,
beans in the right bucket.
then all those qualifications go away.
Gotcha.
And that's just a matter of completing the process that you've started.
Okay, everyone, and then we'll continue? Okay.
Okay, going forward on page 2, we talk about certain Estimates, the main estimates in your financial statements are the two things, the self-insured liability for health insurance plans, which we're not 100%, we can't give you an opinion on that at all. The other one is your estimated liability for your workers' comp claims, and we can give you a opinion on that, and we have. So there is an estimate for your workers' comp incurred but not reported. Every entity, if the county's in a deficit, that deficit is really spread amongst all the participants in the workers' comp claim. All your various towns and any other municipalities that may be there are responsible for that deficit in the workers' comp fund, which has been recorded as a receivable in the current year. Going on, we had really no uncorrected misstatements in everything we looked at. We didn't propose any audit adjustments to Strong's financial statements, other than what management did record for the differences in the funds because of the internal service fund. We recognized those adjustments that were made, and they were made properly, and we decided that we weren't going to make any other audit adjustments to your financial statements. There's no disagreement with management during the year. We did receive the management representations saying that everything that they disclosed, everything that we needed to be fully disclosed to us. There were no management consultations with other independent accountants that we were aware of. We would have to tell you if there were. The other audit findings or issues, as we developed a relationship with management throughout the years, and reviewing the accounting for the internal service fund and the progress of that, that's just part of our normal process of being your auditors, keeping them informed of accounting principles. There is supplementary information in your financial statements that we have disclaimed on. We didn't audit supplementary information in your financial statement that's required by the state controller. There's a lot of things in there that we just don't work with. So, on page 5. Okay, so what do we do here? This is the schedule of financing question costs. These are things that have to be reported to your funding agencies. They look for this schedule. It's very important to everybody involved. As I said before, the type of auditor's report issue, we have a qualified report on your financial statements. We did have material weakness identified in the report. We'll go through those in a second here. We didn't have any significant deficiencies that we needed to report. Was there non-compliance material to financial statement noted? Yes, we did, because of the fact that we qualified the report based on the internal service fund accounting. For your federal awards, we had material weaknesses were not identified. But we did have significant deficiencies in the internal control of major programs, and that's also related to the claiming process regarding your health insurance costs. We audited 3 major programs of temporary, and all these were at DSS, Department of Social Services, temporary assistance for needy families, low-income home energy assistance program, and a medical assistance program. We did qualify our opinion on that for for allowable cost principles. That will be taken care of when the final accounting of the internal service fund is done. We will no longer have to qualify those things. All the claims that have been submitted to New York State and the federal government have incurred these costs that have been on the premium equivalents rather than actual costs. Once they are back down to actual costs where they should be, then these claims will be refiled with New York State, and the county will now be in compliance. Page 6, these are our financial statement findings. The condition was that the administrative and accounting procedures were not put into effect when the county board of supervisors instituted a premium equivalent self-insured health benefit plan in 2007. A trust was not legally established prior to or to the commencement of activity to provide a means to effectively transfer risk to a separate legal entity. So the risk remain with the county as an internal service fund. That's the proper accounting for it. If a trust was established illegally and improperly, the risk would have been transferred to the trust, but it never was. So because you're self-insured for your health insurance, the risk stays with the county, and that was the reason why we have to qualify the report. Until the full accounting is done, then it stays, it'll be qualified. So the criteria is under Gateway Statement number 10. You have to account for these things on the actual cost instead of on a premium improvement for the basis. New York State Fiscal Reference Manual also requires that's how you account for these type of funds. The effect is that the county maintains an internal service fund for self-funded health insurance for itself and other participating local sponsored governments such as the City of Amsterdam. Cost of providing these benefits is allocated back to the other sponsored governments and to the various funds and departments on a premium equivalent basis instead of on an actual experience. And that's what the accounting is going to be done on an actual experience. Because of this, we were unable to obtain sufficient appropriate audit evidence about the recognition of actual health insurance-related expenses and any revenue generated as a result of such recognition because the information is not available. And that's the basis of our qualification. Consequently, we were unable to determine whether any adjustments to the amounts reported on the county's administrative cost claims were necessary.
Joe?
Next.
Tom?
So, back under the condition, you were saying that a trust was not legally established prior to or after commencement of activity to provide a means to effectively transfer risk to a separate legal entity, which in '07, when it's created, needs to be done in order to do that.
Right.
Now that you've dug into that and you've been able to look deeper, you're trying to separate it all with your accounting of that.
The county will be, yes.
Right. Are you ever going to? Is that ever going to be able to happen?
Yes, we believe it will be happening, yes.
So by
the end of this year, by that time that your next audit reports are due, April,
right.
by next April, when you do it to the state controller, that's when we anticipate the accounting to be done by then, right?
So is the reason for that separate accounting because the trust is a separate, or was supposed to be a separate entity, and then with all the municipalities involved?
It really has to do with the transfer of risk. The whole idea was by making a premium equivalent payment to a separate legal entity, the risk transferred
With that, not with
to
the
that
county.
entity
Gotcha.
and left the county, but because that entity wasn't legally created, that step never happened. Now, you're not wrong for being confused. Well, the reason I say that is because within the last, I want to say within the last month, but it probably was in the last 2 weeks, the Office of the State Comptroller released their latest report on your county. And in that report, they referred to it as a trust. So they don't even know the difference.
That's
So-
what's confusing to a lot of people. Where I'm getting at is when you look at this audit, it was just released, it refers to a trust that was created, yet we have
That trust
folks that are
never
doing
was
our auditing
created.
saying, well, it's not.
It was never a trust. A trust was never created. The intention was to do that, but it never,
So therefore, the risk stayed with the county.
exactly.
And I think there was two parts of that. The one part is effective January 1, Sean's been accounting for on an actual basis. So as of January 1, we do have an actual basis for determination
15.
in 13,
Yes.
January 1 of 13. Sean started accounting for it on an actual basis. What we're trying to do is separate those prior years, but that's different than the current year. So going forward, the next audit should be a clean audit as far as,
And when the accounting is done for the previous 4 years, that internal service fund eventually will go away because we won't have any more participants. Okay, so those assets have to be distributed accordingly to the various participants that were there.
That were there.
Yeah.
Or made whole for any shortages that those participants might have contributed to. We don't know, I mean, that's, you
That's
got
what
to
you're-
you gotta
that's what
look
you're
at
trying to
both
get at.
sides, yeah.
So, what will you think will be the effect of that? Premium equivalents overstate the balance or understate the expenses?
It looks like the premium equivalents were higher than the actual cost. Okay, and in the fund itself, the internal service fund, we'll get to a second week now, there is some assets available as of end of 2012, which we have been established either as a liability to the county or to other governments. And based on, we can't give an opinion on that. You know, it's based on certain head counts, but it's not based on actual. So, therefore, we believe just the fact that it happened, and that you went to this self-insured type of product, all participants actually save some health costs over the long run, so there is assets available.
If we looked at the internal service fund, at the end of 2012, there was $2 million worth of cash in. Now, it's important to know, it's about $2 million. Now, it's important to know that when you go to the doctor, like let's say you went to the doctor today, there's a lag between the time when you go and the doctor gets paid for that. There's an estimate for that lag, that chunk that has been incurred but not reported. The four-letter acronym is IBNR, incurred but not reported. That amount, so there's a twofold problem with the internal service.
Why don't we go to page 16 anyways, right here?
Okay, yeah, we can go look on page 16 real quick. When we go look on page 16,
I just want to say what we did here is we took all the funds that are throughout the annual update document, and this summarized them on page 16 and 17, so it's easier to go through it for this presentation.
when we go into the internal service fund, which is 1, 2, 3, 4, 5, 6, the second column over from the left, you'll see that there's 2.3 million in cash and cash equivalents, and then there's some restricted cash and cash equivalents in there as well. So there's $2.8 million in there, and then a little bit of receivables. Down below, under the liabilities section, we show accounts payable / agency liabilities. You see $521,000. That's an estimate of the runout, but it's an estimate and not an actuarially determined estimate. Sorry, that's a hard word to say. I have to say it slow.
It's a best guess, right?
It's a best guess, but if we would recommend that you have an actuary determine what that is, because that number might be too high or too low. Right now, you're just your third-party administrator has taken their best guess as to what it is, and to be most prudent, you probably should have that actuarially determined. And if you did that, it may come up right there. It may come up half that. It may come up twice that. In a normal world, you're looking at between a month and a half and 2 months worth of claims in a lag like that, in that IBNR. But that presumes, of course, that at the end of the year, you didn't have someone that had a heart transplant or something like that, you know. We just don't know that stuff. And with HIPAA, neither do you.
Okay, I think Barbie is here.
I do. I've learned a lot since I've become a supervisor, but dealing with the $2 million, that was when we started with the consortium, and we're going from the Article 47 to the 44, so we needed that reserve in order to meet those requirements. Isn't that correct?
When it was established, there must have been an estimate for that reserve.
Right, so that's why that was created, okay.
And the cash is still there, and you can see how it's been allocated. There is approximately $2,166,000 due back to the other funds of the county right now, okay? Which is not auditable until all the accounting is done for those years, okay? So it could switch. It could be, it probably will be a lot different than it is right now.
Yeah, go ahead, Tom.
A minute ago, you said, I thought you said that the premium equivalent, correct me if I'm wrong, which is the amount we charged per se, the individual contract or the individual person or the county,
To the county.
was more than what we actually, what it actually cost. Isn't that how the 2 million built itself? 40 years?
In both those cases, it doesn't matter because the trust was never legal in the first place. So any money that you were sending over had no bearing. You can't put money into a trust that doesn't exist. You can't build reserves in a trust that doesn't exist. You have to have the trust first, then create the reserves.
Well,
So
and
it's a
take
case
it-
of risk again.
Yeah, and to take it one step farther, if it went there through the Article 44, 47, or if it went there through higher premiums, that we don't show on any of the other funds of the county a due from the internal service fund or a deposit to the internal service fund. So however, the mechanics of however it got there, at the end of the day, it got recorded as an expense in each one of the funds, other funds, in the general fund, the highway fund, the federal funds. At the end of the day, the expenses in those funds were bigger than what they would have had to have been because the risk didn't transfer and we just didn't incur those expenses.
That's the real issue, is the risk that never transferred.
And at the end of the day, in all likelihood, it's a combination of those two as to how the money got there. But how it got there isn't so much an issue as the fact that it's there and it's not recorded as an asset anywhere else, and it's ultimately going to wind up being accounted for back where it came from when we finally figure out where that is.
So while we're here on page 16, why don't we just go through where we, the county is,
Rubik's Cube.
where the county is at 2012, okay? General fund, we're qualifying for the general fund, and the big, the fund balance there at the end of the year is 10,130,000, of which almost 7.4 is unassigned. Now, what I want to point out here is that there's an amount called deferred revenues on here of $7 million. And that's recorded as a liability. That $7 million will be resolved because it's deferred revenues based on the fact that all these claims that were sent to DSS over the years have been reversed. And instead of recording the revenue, they're
About 4 million in it.
about 4 million or 7 million will be determined when the accounting for those 4 years are done. And at that point, it might turn to fund balance. We don't know yet. Okay, so it's been deferred. But it's a good sign, it's a good sign. So if you look at your general fund, $10 million, 130,000, 7.4 is unassigned, which is about 10% of your next year's expenditures. It's not a bad spot to be in. We know the fiscal stress of the county, the report that came out from the controller suggested that you've been using fund balance every year to balance your budget. This year, with the exception of how we recorded, we deferred lots of revenue. The county still had, go to the next page, page 17, an increase in its fund balance of $1,255,000. So even though you might have budgeted the use of fund balance, it looks, we can't give you a 100% opinion on it, but they increased fund balance by $1,255,000 during the year. So.
Yeah, Tom?
So, if I understand it, you increase fund balance a few different ways probably. One, you didn't spend what you budgeted. It could be, may have over budgeted. Or two, you had increased unanticipated revenues, sales tax, or wherever they might come from. So it's hard to determine right now exactly where that happened, but it could have been from over budgeting or a combination of unanticipated revenues. We just didn't know it might be that high.
It was a combination.
Combination of the two.
So that's a positive.
Well, it's positive as long as, it's positive as long as you're not over budgeting taxpayers in the course of thing, but it's a guessing game.
It's a guessing.
It's a difficult game.
I think tomorrow night you'll see that, you'll see it in social services where probably $3 million of it came from, more or less, Sean? You know what I mean, where they underspent on certain programs, 2.5 million, and I think their increased revenues was like another $500,000. So that's part, sales taxes part, there are a bunch of parts to it.
And I think it's interesting to note when we're on page 17 under the general fund, under expenditures, it says economic assistance and opportunity, there's $25 million, but by far and away, the vast majority of that is DSS related. Or you could call them expenses over which you really have no management control or say so.
Economic system, and if you look at page 17, the employee benefits, $9,935,000 contains health insurance benefits, which we cannot give you a total opinion on that because of the accounting for the self-insurance plan. And that's what it was during the year. So that'll have an effect. You do claim your self-insurance benefits, all your health benefits are direct costs you can get reimbursed for from New York State in DSS programs. So that has to be resolved before all these revenues and expenditures can be properly accounted for. There'll be a prior period adjustment next year.
Okay, Butch?
So what you're saying is that this premium, okay, was more than what they should have, so all the expenditures or appropriations from each department was excess. Correct?
Yes, could be, yes.
But you don't budget
We don't
health
budget.
insurance by department, you budget it in total.
Well, I understand
Yeah.
that.
But yes,
But yeah.
conceptually, yes, you're right.
Like the new accounting methods
Okay.
probably should be, you should be budgeting it based by department. So then you can budget your revenue. Like one of the things that positive that's coming out of the whole thing here is that your retiree health insurance for anybody that was retired out of social services is a direct cost. So you're paying your net share of retiree health insurance. Those are now direct costs that could be claimed and reimbursed from New York State, where in the past you had, once the accounting is all done for that, those claims will be adjusted to reflect those additional costs that you weren't claiming for before.
By department?
By department, only for those departments that can get reimbursed for those expenses.
But in other words, we're keeping track of every cost by department for the most departments. And then we lump a bunch into other. But social services happens to be the biggest one. So we're taking all of their costs, all of their meds, all of their dental, all of their vision, and we keep, and Sean has it, keeps track of it.
Just for social service?
Well, we do it for we do it for the sheriffs, we do it for public health, we do it for all the bigger departments, and then the smaller departments, we lump them together.
And the personnel department?
Well, it all shows in personnel, but.
Yeah, that's where that's where it first arrives, and then
Then you take it out of the personnel department and you're going back to the individual?
well, we're not
You're not showing
paying.
it individually in a budget, you're showing, we have it broke out individually
Right.
as like a subsidiary account.
In other words, there's no extra money going into this M fund. Because what we're doing is we're reimbursing the M fund. So there's nothing, no extras ever going in there again.
If we're going through all of this and everything, why can't we have it by department?
Well, we do have it, but we don't have it in the budget by department. You'll see tomorrow night where the benefit now may be in the 6 digits in our reimbursement for social services because they're capped on their indirect costs, and we were always exceeding the indirect costs. So we never got reimbursed for the monies above a certain cap. Now that the money is going in as a direct expense, we're getting reimbursed for it. We should have an improvement in the 6 digits on our revenue side. Reimbursement back. Hopefully tomorrow night we'll get into that.
And that's part of the prior payments that you deferred.
Right now it's deferred. Until
So
it's
you could
fulfilled.
end up with $3-4 million back in your fund.
And we may find out, I'm not saying that we're going to, but we may find out that we should have been entitled to claim more. That's something we just don't know, but that is a possibility. Or we may have overclaimed and have to get some of that back.
So because of the way we were doing it for the trust that we may or may not have with the cost equivalent, it shorted the expenses by the department, which would have been reimbursed.
It might have been overclaimed at some point, but now because of the retiree health costs, we can recapture it. It might break even, we don't know what it's gonna be until all the accounting is done there. And if there's a lot of accounting that has to be done, every claim has to be looked at.
And it could take, one sick person could skew things dramatically from one year to the next because
So if you have a real healthy department, you'll be okay. If you have a real sick department, it might be bad, so.
Okay, you want to continue?
Sure. Okay, thank you. Okay, we went through the scheduled findings and question of cost. Page 6, our recommendation is, and which management is following. About on page 7, we said that since the county should not ignore its responsibilities, the only question becomes the manner in which the county addresses their responsibilities over the self-insurance plan. So we are again recommending that the county go through this accounting and finish it up in the internal service fund so they can properly record those expenditures. We're also talking on page 8, the present accounting system only records its healthcare costs for one journal ledger account. Each fund does not report these costs by department cost center. We do recommend that you have a separate cost for health insurance for each of your departments. And it sounds like you went to a subsidiary ledger to do that, and that's based on our recommendation. The next finding is 2012-2. There was a delay last year in submitting your reporting package to the federal government because of this accounting issue. And it's been corrected that all the state agencies will get their reports on time for this current year. Based on this qualified opinion. Last year we didn't, it was not issued for February. On page 9, this is our finding regarding the cost accounting for these 3 programs which I mentioned before: temporary assistance for needy families, low-income orange assistance program, and Medicaid assistance program. All submit these claims to the actually New York State Office of Temporary and Disabled Assistance, OTDA. So because the claims were in error for all these years, we had to qualify our opinion over those costs. They weren't in accordance with actual costs; they were based on premium equivalent. So that's our qualification. So the office of New York State Office of OTDA is aware of this and is expecting that the claims will be resubmitted properly in the future. And we did have one other finding. I will go for on page 11. We did look at the temporary assistance for needy families program application process. We noted that all applicants are required to sign a certification that they're American citizens and they're eligible for these benefits. And we noted that 5 of the 60 applications we selected testing were missing those signatures. We discussed this with the department and the commissioner, and they've actually gone through and required that all certifications be reviewed, and they've also implemented an internal audit process to ensure that they are now are approved and signed off.
we didn't find any question costs because those signatures were missing, but the risk is that someone would not be eligible, and you'd have to pay back the grantor agency for the funds that you expended erroneously. That wasn't the case, but that's the risk that we're attempting to address there.
Okay, on page 12 is our actual independent auditor report, which is in the main document. It's a report on the financial statements. And again, this is saying what we are statutory basis. Balance sheets, it's the annual financial report update document prescribed by the New York State Office of State Controller. We also engaged the statutory basis the year before, and we issued an opinion on that, which was a disclaimed opinion. Management is responsible for these financial statements. Our job is to audit those, so that's why we have to communicate that here. Our responsibility is to express an opinion on these statutory bases in accordance with our audit standards and additional standards that are contained in the government auditing standards, which is issued by the Comptroller General of the United States of America. Because you do receive federal funds, we have to audit under those additional auditing standards. On the next page, we have to give you a basis of an adverse opinion on generally accepted accounting principles. Basically, your financial statements are not in accordance with generally accepted accounting principles. GASB 34, Statement 34 requires you to have a government-wide financial statement. It requires you to have infrastructure. It requires you to start depreciating your fixed assets. It requires you to have a actual report under GASB 45, which is an actual report for other post-retirement benefits other than pensions. You don't have any of those in these statements. It's not required by New York State, but it is required by general accepted accounting principles. So that's the reason why we have an adverse opinion on your total financial statements, because they're not in accordance with what's required for governments in the United States of America. So this report, it does not correspond to Government Accounting Standards Board requirements, which we have to tell you about now. So we also have we have a basis for a qualified opinion on the 2012 statutory basis of financial statements, which basically has to do with the health insurance that we talked about previously. So we have a qualified opinion in there, and our qualified opinion is right on the bottom of page 13. Which basically says, in our opinion, except for the effects of the matter described in the paragraph above, the statutory basis statements referred to in the first paragraph present fairly, in all material respects, financial position of the county, related operations, changes of fund balance, cash flows, or budget summaries for the year ended is on the basis of accounting of the New York State Office of the State Controller. We also had a correction of error on page 14. These were certain errors resulting from an overstatement of the health insurance statutory basis reimbursements for claims filed on expenses as of January 1st, 2001. So we restated the beginning fund balance of what was previously issued there. So we had to put that in our report. There's required supplemental information here. Throughout that main financial statements, we did not audit that statement, any of that information. So we issued we say that here, we do not express an opinion or provide any assurance on that information. We did audit the schedule of federal awards, schedule of expenditures of federal awards. It's not a required statement, but it's required by OMB Circular A133. And in our opinion, on page 15 at the bottom of that, we do give you it's fairly, in our opinion, the schedule of expenditures of federal awards is fairly stated in all material respects in relation to the base statutory basis financial figures also. There's a CFA in there, it's called the schedule of expenditures of federal awards is fairly stated. We went through, we looked at page 16.
And then we looked at page 7. The statement of revenues and expenditures and changes in fund balance. Now, we qualified our opinion with respect to the general column and the one that says internal service. The rest of them, we're okay with everything that we showed there. And basically, this is the equivalent of an income statement for us people that think in the private world. And there's the revenues at the top, the expenses at the bottom. Then there's transfers. And then the changes in each of the various funds. Now, capital projects fund, that's gonna go up and down depending upon what you're doing and where you are in the process of funding capital projects. If you just issued a ban, you're gonna have a big number in there. If you just expended money and used the ban that you issued in prior years, you're probably gonna have a negative in there. Right now, you're a little bit upside down in the capital projects fund. That'll resolve itself going forward. But all in all, in each one of the funds, you're in pretty good shape. One of the things you'll notice is that for the internal service fund and the self-insurance fund, there is no fund balances. That's because those are kind of like trust funds where you account for just the balance sheet activity and on an annual basis, they're supposed to break even. Because you either give back what you collected in excess of what you needed, or you bill more if you didn't collect enough. But at the end of the day, those funds are supposed to be zero because the activity winds up getting pushed back into the other funds where it belongs. And that's what you'll see in each one of those. That's why there's
Like our sewer district.
or your sewer district, you actually have a positive fund balance.
Is that what you're talking about, those types of?
Yeah, where you would push back those costs into like the sewer district, yeah. You know, like the health insurance or the workers' comp would go back to the sewer district based upon whatever the actuals were.
And then if we go back to page 16, I can show you where that is. We have the internal service fund we talked about. Self-insurance fund is your workers' compensation self-insurance fund. It had cash 2.4 million. It had liabilities of 3,098,000, which is called, okay? What the adjustment was made by management this year is to record a due from other governments of about $721,000, which represents the excess of those incurred but not reported claims under the self-insurance, more than the cash you had. You are required to record that asset. You do have the right to collect upon any withdrawing government. If there is a deficit position for any participant, they will be required to repay this fund if they were going to leave that participating town or village were going to leave this consortium. So there's a receivable there of $721,000.
And just so that we correct this, that when originally that showed up as a negative fund balance in the reporting as we have been doing it for the last several years, which showed that the operation was losing money as we've seen it. All right. Now the correction is that you can't have a fund balance. You can't have a negative fund balance or a positive fund balance. You either owe money to somebody or they owe money to you.
Right.
In this case, we have a $721,000 that's due from other governments. Now, I take it part of it is due from the Montgomery County. All right?
Yep.
And whatever proportion of the self-insured fund is. And the rest of it is due from the towns and villages that participate.
Yes.
Now, so we're carrying it as a receivable, but it could be offset by future gains.
Yes.
So there's nobody out there sending a bill to the town of St. Johnsville saying that you owe us $21,000. But in fact, somebody at this point owes money.
Right. Right. And
Correct?
basically, I mean, you have enough cash to operate. Okay, the fund
Right.
has enough cash to operate and pay its claims currently. But if there was one of the governments one of the participating governments was going to withdraw, there is a withdrawal liability that's associated with that withdrawal, and that's what this receivable represents.
So when some municipality decides that they might not want to participate with us any longer, all right, then the fund could end up having issues. Correct?
Let's say one of your towns had.
Or a city,
had
or a city for that.
Okay, somebody had a highway department worker that fell in a hole and injured his back. The actuaries determined that the workers, that's covered by workers' comp, that to take care of the workers' comp covered claims for the rest of his life or the duration of that condition, it's gonna cost X. It doesn't mean that you've spent that much. It means that you have a liability because you're self-insured to do for whatever. And in this particular case, your unfunded liability based upon the actuarial estimate, which could go up, it could go down, someone could get better, someone could die unexpectedly. Somebody else could get hurt, next year the liability could be $1 million bigger. But if business ceased at the end of the day on December 31st, 2011, you'd have to collect $721,000 from the participants to cover all the exposure that you had.
Okay, Tommy?
That's where I was going. So using your hypothetical, the town of whoever is participating had this worker that got injured, and there's a liability there for future costs of $200,000 because of the type of injury. What you're saying is, for that town to get out, there becomes a cutoff date, and we know what those unfunded liabilities are. At that point, we say to that town, here's what your exposure is, and this is what the unfunded liability is that you could owe us if you decide to get out today and stop participating.
Right.
Just save the
District pension. That's right, and it's based on actuarial assumptions, because in effect, the actuary's standing there and he's saying, all right, that guy hurt his back, it's gonna cost,
Well, what
$10,000 a year, but it's gonna go up by inflation every year, and then they discount it back at present value, so they increase it, and then they ratchet it back to present value.
It's also looking at the run out of, so I
Yeah.
come in and say, I'm gonna get done at this time, December 31st.
Yep.
Okay, fine. You don't have any major issues, but you have a run out of claims for the next 3 months. That's your liability. That's your portion of the
It
pie.
could be for the next 30 years.
Well, or it could be for,
That's right, it depends.
Fire districts are included, so, and that's, they're included in these things, so, there's, you can see, Schmeider's industry, with those risks.
But I guess the important thing is it's an estimate, tempered by an estimate, tempered by another estimate the other way, so it's a whole bunch of estimates thrown together, so.
Okay, what else you got?
Page 18. This is our management letter, confidential, we talked about this before at the previous meeting. These are recommendations to improve internal controls, improve your financial reporting. And the first one here we talk about here is engagement 34. It was compliance and service of the county principal. As we mentioned, we have an adverse opinion because you do not, but the statements that are presented here are not in accordance with generally accepted accounting principles. So we're recommending that the county decide whether or not they want to implement GASB 34. We noted that certain jurisdictions, certain funding agencies, such as the next page, U.S. Department of Agriculture, have been requiring even a small little village, if they want to get funds under rural preservation grants for water or sewer projects, they're requiring them now to record all their activities under the GASB 34. The county does not, and you're probably one of the only counties in the state that does not. Just surprised there's other ones that do, that follow your same principles. The state Office of State Controllers accepts your reports as is. We're just making the county aware that you may want to implement this future funding sources may need it, and perhaps future debt proceedings that you might go into. They might be looking for 34 statements. The second bullet here on page 19 is the recording of post-retirement benefits other than pensions. You do provide health insurance benefits to your retirees in accordance with local law number 4 that was established in 1993. The county's collective bargaining agreements are silent in regards to retirees' health insurance. So one of the things we're looking at is that there's a law that's there, it's not addressed in your collective bargaining agreements. You should be looking at that to consider including that local law in future collective bargaining agreements. And again, going forward, on the next paragraph, the county has not implemented the requirements of GASB statement number 45, which is called accounting and financial reporting by employers, which you are, for post-retirement benefits other than pensions. That's really the entire health insurance, any kind of a county-sponsored retirement incentive program would be included in that type of format. There is a schedule in the controller's report that they suggest you put it in there, not requiring it, but there is a schedule in there, it's blank for the time being. So we're making a recommendation that you consider looking at that, that KZ 6045 requirement and include information in your report for taking forward, also for managing your retiree costs. Looking at it, have an actuary perform this thing has been, this report will open your eyes up. What is that liability right now? There's a huge liability that all other counties are reporting relating to retirees' future cost insurance. And the final one I'd like to go through, Internal Service Fund Accounting Administration.
The final one is kind of like a rehash of something you've heard numerous times. It basically deals with the accounting for the Internal Service Fund, so that it's based on actual costs which get allocated back to the departments at actual instead of based upon premium equivalence. And we put this in there because we wanted you to know that that was the reason why we qualified your opinion. And we basically walked through and pretty much lockstep with what we said in that finding with respect to the accounting for this. And just pointing out that you're doing a great job of getting there, and we think you need to keep going.
Okay. In a minute, we're going to talk quickly about that draft audit from the state. All right, so we should stay just a little bit for that one. But before we get to that, you made a remark earlier that said, and this has been the confusion that goes on within the board for years. When you looked at the audit for 2012, you stated that the fund balance actually increased $1.5 million, and that we actually didn't use any fund balance, so it actually grew. We actually appropriated, so when we adopted the budget, we appropriated $4.9 million. So when we appropriate $4.9 million, and we think we're going to use $4.9 million, and we actually increased by $1.5 million, we missed that budget somehow or another by over $6 million. All right, that's the key part about this. In the audit, there was the draft audit, and there was some confusion here about the draft audit. There are two parts to the draft audit from the state controller's point of view. One is the response that they wanted within 30 days. The response that they wanted from the finance committee would have been, do you accept their draft report, or don't you accept the draft report? That's how simple it was. Right? It got way overstated on what was involved there. The second part of it is that the board within 90 days will come up with a corrective action plan. So it's the board that has to come up with a corrective action plan. But part of the confusion is this missing the budget by $6 million. It's not so much that we appropriate the fund balance in order to balance the budget, but we have such a differential between what we appropriate and what we use. Sometimes we appropriate it and we use even more. Sometimes we appropriate it and we actually gain. So when we look at it on a chart, we can see that. But we need that to come up with a corrective action plan. How are we going to deal with that? All right, so it's sort of, and the reason I wanted to say that was because in the audit part, you know, when you look at the changes in fund equity on page 16, or better yet, on page 6, what they're going to see is an unassigned fund balance that goes from 2.8 million to 7.4 million. And somebody's going to look at that and say, wow, you know what I mean? The county really gained in fund balance. But actually you restated part of that prior year fund balance. So they really need to look on page 16 to see that our fund balance really only grew $1.5 million, not $5 million, right? So, do you have a question, Tom?
Well, I guess, just for clarity purposes, I hear over and over and over and read over and over and over and over in the media that the fund balance is continually spent down, spent down, spent down, spent down. Well, I think what Supervisor Stagliano has just described, in particular that year, we said, here's what we think we might use for the upcoming year. We said it was 4.9 million. We actually end up 1.1 over that. We really spent down nothing.
Oh, you
Oh,
gained.
you gained, right? Yeah.
You spent down nothing.
But the truth to the draft audit was we were at 17 or 20 million. And we actually got down to 4 million or whatever it was we were actually at. So we did decline a lot. But we turned this corner, we're going up. Now the question is that a trend going forward? We don't know. And we won't know until we review this budget and thoroughly.
And to take that one step further, when you look at where those big differences arise, you've got to remember that a third of your budget, or just about a third of your budget, is DSS related expenditures. And I think it's important to understand that as a board of supervisors, you're kind of charged with managing all this stuff. And I think it's appropriate for you to be held accountable for things that you can manage. But there's things that you can't manage. You can't decide how much social welfare programs are going to cost in your county. That's a function of what happened, and there's no option for you other than to be reactive and to budget for them. And I suspect that if we dug into the numbers in great detail, you'd find that that's where your biggest budgetary variances are on a year-by-year basis, revenue and expense-wise. Because you can only take your best guess, and circumstances change. That's why a budget is a guess. And when you're putting together a budget, if you're putting it together as a prudent man, you're going to put it together to cover the worst-case scenario.
See, the concern I
And hope
have,
it's better.
the concern I have, and I think I expressed it last week, was that if it's a $29 or $30 million budget, 5 million of it, or a little bit more, is basically the administration, which is for most part salaries and some contractual expenses. So there isn't a great difference there. There's 12 million, which is Medicaid. That's a fixed number. And you're going to spend $12 million exactly on Medicaid.
And it's gonna go 3% every year.
And it's going to go up 3% a year. So you know that. So what were the programs that were left? It was juvenile delinquency and a few other programs that somehow or another we missed by $2.5 million in a few of the programs. Because it sure wasn't a Medicaid, because that's a fixed number. So those are the questions for tomorrow night. And that's where tomorrow night is where we're going to determine, is there any use of fund balance required or no use of fund balance required? Because for most likely, it's in that budget. Because that's where the excess was in 2012. So.
Just to add to our comments regarding GSB 34, in those statements, what's required in those statements is a schedule that has your original budget, your changes in your new budget, your final budget, and an explanation of the changes, and then a comparison to actual. And those statements are not included in these packages, but it is a nice, useful management tool to have those in your financial statements for the users, any users of the financial statements to have available.
One final thing before you go, and this is just in principle. It's my impression that as you as external auditors become more and more independent from the county, it's putting a bigger and bigger strain on the treasurer's office to have the manpower that can oversee what you do. And I think that's where, I think that's where your field is going. So if you can come in, if you're coming in and finding the flaws in our system, you're not able to help us correct it because you're maintaining your independence.
Yes, we can make the recommendations, all right? And that's what we can do. But we can't implement.
Okay.
We can't make management decisions. Otherwise, we can't issue an opinion anymore, so,
All right, so that, I mean, that just, as time goes on, it puts a bigger and bigger strain on the treasurer's office.
Yes.
So I just want to make sure everybody understands that. Any other questions of the gentleman?
Thank you for your patience.
Okay.
Thank you.
I didn't think that looking at an audit would be so exciting.
Thank you for your time.
Huh? There's only a few of these that enjoy it. Okay. I guess there isn't much more to say about the draft audit other than we're going to be working on the corrective action plan between now and the time that we end this form of government.
Yeah. Are we gonna have meetings?
Yeah, finance.
For the whole, finance?
Well, no, it has to.
You'll let everybody know?
Yeah, but it has to
All
be,
right.
no, it has to be adopted by the board of supervisors.
By the 12th, yeah.
All right,
But
so-
you'll invite everybody, yeah.
So everybody's gonna be by then.
All right, rock and roll.
All right? So having said that, we want to go on to number 2, resolution authorizing the chairman to hire legal counsel.
Yep. What up?
Sponsored by Strebe, seconded by Shira. Is there any discussion?
Can I just ask a question?
Sure.
I'm not on the committee, but can I just ask how much is in the revolving loan fund?
Right now,
Mm-hmm.
I don't know if the last quarterly report you guys got, probably a couple million.
Okay. And this says, I'm not on this committee, so I can't vote, but this is not to exceed 200 per hour. Is this capped at a certain amount?
Yeah, you had that the same amount that it is now, which is 1,500.
Okay.
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 Any other questions? If not, what's the, move it? Next resolution authorizing the county treasurer to disperse mortgage tax monies.
Oh, yeah.
Supervisor Quackenbush and Supervisor Strebe. Are they up, Sean?
Some up, some down,
Okay,
depending on what municipality you're in.
all right. Any other questions of the treasurer? If not, what's the recommendation of the committee? Move it? Okay. Resolution approving re-levy of delinquent school taxes, village taxes, water rent. Supervisor Chair, Supervisor Quackenbush. Any discussion?
Move it.
Move it?
Yep.
Resolution amending 2013 operating budget, insurance deductible. Needs a sponsor. Supervisor Quackenbush. Supervisor Strebe. Sean, you got quickly what that's about.
Went through purchasing, I don't know if Cheryl, it has to do with a deductible for
I
one
know.
of
The sheriff's
the cases.
department, I forget what piece it is, but it's for the sheriff's department.
We didn't have enough money for the deductible?
Correct.
And that's what it is? All right. Anybody have any questions? Yeah, huh?
Strip search.
Script search.
Script search?
What?
All right.
It has to do
Okay,
with the law.
What's the pleasure of the committee? Move it?
I've been here too long.
Move it? Yeah. All right, we've got a resolution to, oh, I'm sorry, there's also one add-on.
Wait,
No, it's for the 22nd.
Yeah, no, I want to add on to it. So, a resolution approving the abstract of audited claims. Is there a sponsor, Mike, Chair, Herbie Allen? What's the pleasure of the committee? Move it? Move it? Look, I got one add-on, has to do with with youth and ATI and veterans. And that's has everybody got a copy?
I'll put it on everybody's desk.
Yeah, it's sponsored by
Sweet.
Brian. I need a second.
Yeah.
Bill? It's a resolution amending the 2013 operating budget, and it has to do with mileage allocation. If we didn't pass this, Leslie would have to wait 2 months in order, because there's not enough money in the account to pay it. So that's why it's sort of, an add-on. What's the pleasure of the committee? Move it?
Move it.
Move it. All right. Anything else come in front of the committee?
Nope.
You made a comment about the Sean's office with having enough personnel. What do you need? Do what he's
Well, I
asking.
don't know if we talked about enough personnel.
Well, what would you need to comply to what they're talking
Totally?
about? Yeah, you're here to tell us.
Like I said, some of the stuff that they're recommending, you're talking CPA caliber.
Yeah.
Okay.
I think that where the accounting industry is going is moving their independence further and further away, separating it from the client, us. And so now we're being required to actually have the expertise to oversee them. And they were here to oversee us. So it's going to require in the future years, maybe not so near future, you know?
To do the simple, some of the simpler tasks, like they said, as far as the separation of the health insurance and stuff, but if you're going to go full-blown GASB compliant, GASB 35, 45, 54, like I said, a lot of that, and when that went through the state, a lot of treasurers ended up hiring CPAs to,
Yeah, you're looking
An
at,
actuary.
you're looking at additional costs, either employees or outside contracts for additional help to fill that gap. So I just thought that we should make them all aware of it, so that going forward, they'll know. Tom?
Well, I guess my comment was, and Sean said, if that's the way you want to go. I think, I mean, my own personal opinion is you hand over to the taxpayer to be able to show them. You know, because when you have audits that come out from the 1 week and then another one that almost, talks about it, not being quite so right, I mean, it confuses people. It really does, so.
This audit is a clear improvement from last year's. I mean, this is leaps and bounds above last year's. So,
It's on time.
huh?
It's on time.
Yeah, Bill, do you have a question? Anything else come from us? Is there a motion to adjourn? Mike? Bill, all in favor?
Yeah.
Aye.